In today's episode, I'll talk about two interesting stories. In the first one, I'll talk about how Taiwan's currency suddenly surged about 6% and the hidden financial system behind it that almost nobody talks about. And in the second story of the day, I'll talk about how a telecom equipment dispute landed Samsung in a 5,000 crore rupee tax battle with the Indian government. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Friday, the 9th of May. Let's begin with the first story. See, something very unusual recently happened in the currency markets, and it is worth paying all our attention to. See, over the past few days, the Taiwanese dollar, which is also denoted as TWD, jumped more than 6% against the US dollar. Now, for most people, that may sound like just another number, but the thing is, in the world of currencies, that is a massive, massive move. And this is especially so for a currency like the TWD, which usually moves only by a few tenths of a percentage each day. And it hasn't seen a jump as dramatic as this since the 1980s, which is about 45 years ago. But before I get into the details of what's exactly happening, let me slow down a little bit and first help you understand what it even means when a currency jumps or even appreciates. Let's understand this with an example. Say last week you required 33 Taiwanese dollars in order to buy one US dollar, and now you only need 30. Now that means that the TWD has strengthened or appreciated relative to the US dollar. And from Taiwan's point of view, each unit of their currency now buys more dollars than they ever did before. But on the flip side, the dollar has weakened or depreciated relative to the Taiwanese dollar. And that is what people mean when they talk about currency appreciation or depreciation. Now, the thing is, these changes matter quite a lot. A stronger currency can make a country's exports a lot more expensive for other countries to buy and imports cheaper for its own people. It also affects investment returns, trade profits, and financial decisions that are made by large companies and investors. So the question is, what exactly caused such a sudden and massive appreciation in Taiwan's currency? See, to answer that, we'll need to look at Taiwan's economy and more specifically how it handles the money that it earns from trading with the world. See, Taiwan runs a big trade surplus. That means it exports a lot more than it imports, especially in high value goods like semiconductors and electronics. In some years, this surplus has crossed more than 10% of Taiwan's entire GDP, which is very high by global standards. And as a result of it, Taiwan keeps earning large amounts of foreign currency, especially US dollars, year after year. Now, the thing is, in most countries, when this happens, the central banks usually steps in and buys up those extra dollars and then adds them to their foreign reserves, just like the Reserve Bank of India does as well. But Taiwan has a little bit of a different setup here. Instead of the central bank absorbing all the foreign money, much of it gets funneled through Taiwan's life insurance industry. And that, mind you, is a big deal because Taiwanese life insurers are financial giants, so to speak. Together, they manage close to 1 trillion US dollars in assets. But Taiwan's own financial markets are not large enough to absorb that kind of money. Its bond market is small, its stock market is not broad enough, and its real estate market is already way too expensive. So the thing is, these insurers do what any rational investor would, which is that they invest overseas. And the question then is, where does all that money go? Of course, into US dollar denominated assets, which is US government bonds, corporate bonds, and a special type of bond called Formosa bonds. Now, these, for your context, are issued in US dollars by foreign companies but are traded in Taiwan. Now, all of this has sort of created a huge dependency on the US dollar within Taiwan's financial system. In fact, foreign investments by Taiwanese insurers have now exceeded 60% of the country's GDP. And that is why the exchange rate between the US dollar and the Taiwanese dollar is so important. A big swing in this rate can sort of mess up the entire balance sheet of the country's financial system. But the catch is that these insurers sell policies in Taiwanese dollars, but they invest in assets that pay out in US dollars. And that creates what's called a currency mismatch of sorts. If the Taiwanese dollar suddenly strengthens, like it just did by the way, then all the returns they're expecting from the US dollar assets will suddenly shrink when they are converted back into their local currency. So therefore, in order to manage this risk, insurers use financial contracts which are called foreign exchange derivatives, which are things like FX swaps and forwards. Now, these basically allow them to lock in a future exchange rate and hedge against sudden currency movements. It's almost like buying insurance for your investments to some extent. Anyway, now back to the recent events. In early May 2025, the US dollar weakened globally, and at the very same time, there were rumors that Taiwan might let its currency rise as part of some ongoing trade negotiations with the United States. Now, that was enough to spark some panic across Taiwan's business community. Exporters, which by the way in this case are companies that earn in US dollars but pay costs in Taiwanese dollars, rushed to convert convert their dollars into local currency. And that is because if they did not act fast, their dollar earnings, like I said, would be worth less in TWD terms. And now if you think about it, for a company like TSMC, which is one of the major chip manufacturers, this is a very, very serious problem. Most of their revenue comes in dollars, but their operations are actually based in Taiwan. And according to analysts, even a 1% rise in the Taiwanese dollar could cut TSMC's operating margin by as much as 0.4 percentage points. So they had every reason to dump their dollars very quickly. And on the other hand, meanwhile, insurers who were sitting on huge portfolios of dollar assets sort of ramped up their hedging as well. They rushed to lock in better exchange rates before the Taiwanese dollar got even stronger. Everyone was basically scrambling to buy Taiwanese dollars. But there was a problem here. Taiwan's currency market is not very deep or liquid. It's not like the US dollar, euro, or yen, which are currencies which are traded in huge volumes every single day. So when so many players sort of tried to convert their dollars at once, there simply were not enough counterparties to handle all the trades. And the lack of liquidity exaggerated these price movements. The more everyone tried to buy Taiwanese dollars, the more its price started to shoot up. But that said, there were two more things that were happening in the background which made things even worse. First, across Asia, there has been a gradual shift away from relying too much on the US dollar. Now, this is partly because of rising geopolitical tensions and also partly due to fears that the dollar may not remain as strong or reliable in the long run. So financial institutions have been slowly reducing their dollar exposure, and Taiwan is part of that particular trend. Second, and more importantly, Taiwan's central bank has stayed silent. Historically, it has always sort of stepped in to prevent the Taiwanese dollar from rising too fast because a stronger currency hurts Taiwan's export competitiveness, as we discussed. But this time around, the central bank did not intervene. That sent a strong signal to the market, maybe that the government is okay with a stronger currency right now. And maybe it wants to show good faith in trade talks with the US by allowing the markets to move freely. And that only added to the rush, so to speak. But to fully understand all of this, what we need to do is to zoom out and look at deeper history for once. A few years ago, a senior fellow at the Council on Foreign Relations, Brad Setzer, published a fascinating paper. He showed that for many years, Taiwan's central bank had been intervening in the currency markets, but secretly. Basically, instead of buying dollars in the open market and reporting them as official foreign reserves, the central bank was using derivatives, which is forwards and swaps, to quietly take on the dollar exposure from Taiwanese insurers. Now, this basically allowed insurers to hedge their dollar investments without really disturbing the market too much. In fact, at some point, the central bank's derivative exposure was as high as 130 billion US dollars, which is almost 20% of Taiwan's GDP at that time. But there is an interesting part here. Taiwan did not have to report any of this. Why, you might ask? That is because Taiwan is not a member of the IMF, which is the International Monetary Fund. It's basically not a part of IMF's Special Data Dissemination Standard, or SDDS, which basically sets rules for how much countries need to disclose about their reserves and currency market interventions. And the reason for this is because diplomatically, Taiwan is not even recognized as a country by most parts of the world, thanks to its complicated relationship with China. So basically, it found itself in a bit of a gray zone because it was not subject to global reporting rules, and that meant that it could hide its interventions from the rest of the world. And this mattered a lot. If Taiwan had reported those derivative positions, its official reserves would have looked abnormally high. And if a country with large trade surplus is also seen to be manipulating its currency, even indirectly in some way, the US Treasury could label it a currency manipulator. And that brings all sorts of political and economic consequences. But Taiwan was able to avoid all the spotlight by operating in the shadows, so to speak. But eventually, one of Setzer's work got attention and the pressure started building. Taiwan began disclosing more of its forward positions starting around 2020. For the first time, the world saw how involved its central bank really was in the FX markets. And then came the post-COVID world. As the US Federal Reserve raised interest rates, the dollar started to strengthen. Hedging costs for insurers went up and in some cases touched 5% annually. So therefore, insurers pulled back on some of their hedging activities, and central bank also reduced their interventions. And that meant that the market started seeing more real currency movements without central bank smoothing. And that brings me to what's happening today. See, we've got a structurally strong currency because of Taiwan's trade surplus. Exporters are offloading dollars, insurers are aggressively hedging, and there is a broader shift away from the dollar across Asia. There is a shadow illiquid FX market and a central bank that is deliberately stepping aside. And if you put all of that together, you get a rare once in a generation 6% surge in the Taiwanese dollar in just a couple of days. On that note, let's move on and talk about the second story of the day. See, Samsung is currently in trouble with Indian tax authorities. Now, the company, which is one of the biggest electronic brands in the world, is now facing a massive legal and financial fight in India. Basically, the government has asked Samsung India and some of its senior employees to pay up 5,000 crore rupees in taxes and penalties. But to understand how serious this is, consider this. Samsung India made a profit of little over 8,200 crore rupees last year, and that penalty alone is more than 60% of that number. So this is not some minor paperwork issue for sure, it is a big high stakes battle. At the very core of this is a tax dispute of how Samsung classified a piece of telecom equipment when it was imported into India. Now that equipment is called a remote radio head or RRH. Between 2018 and 2021, Samsung imported nearly 784 million US dollars worth of these RRH units from its factories in Korea and Vietnam. These units were then supplied to Reliance Jio, which was expanding its 4G network in India at that point in time. Now here is where things start to get a little bit tricky and technical. When a company brings a product into India, it has to pay a customs duty. But the tricky part is how much customs duty or tax you pay actually depends entirely on how you describe the item that you are importing. The Indian customs system has a huge list of nearly 12,000 different classifications for products, and each single classification comes with its own tax rate. And that list, mind you, is around 900 pages long. So depending on how an item is categorized, the tax could be high or low. Now in general, for your context, India charges lower taxes on parts of a product and higher taxes on fully finished products. For example, if you're importing a complete telecom machine, the tax could be about 10 to 20%. But on the other hand, if you are importing just a smaller part of the machine, the duty could drop significantly to even zero in some cases. And that is what makes this classification such a big deal from the context of this particular story. And that's also what the entire fight between Samsung and Indian customs or the Indian government is all about. See, Samsung claims that these RRH units are just parts of a telecom system, not full-blown machineries. So they paid very little duty on them. But the customs department strongly disagrees to this. They say that these RRH are not just parts, but they are actually transceivers, which are devices that can send as well as receive signals. And if you are importing a transceiver, you should pay full duty, just like how you would pay on any complete communication device. So the Indian government is basically accusing Samsung of misclassifying its import on purpose in order to avoid taxes. They say that Samsung's documents are misleading and even called them fake documents that were used to trick the system. And based on this, the government has raised a demand of 520 million US dollars, which includes the unpaid taxes and an additional penalty that doubles the amount. And on top of that, there is another 81 million US dollars worth of penalties that has been slapped on 7 senior executives of Samsung India. These officials have basically been accused of actively participating in what the authorities are calling deliberate act to dodge taxes. Samsung naturally, of course, is not accepting these charges. The company has taken the matter to the Customs Excise and Service Tax Appellate Tribunal or CESTAT, which basically handles dispute like these. They basically want the tribunal to cancel the customs order and make it very clear that they did nothing wrong. But to understand why this argument is so complex in the first place, let's first very quickly understand what an RRH actually is. See, a remote radio head is a piece of equipment that is used in telecom towers. It is usually installed right near the antenna at the top of the tower. Its job is to take digital signals from another device, which is called baseband unit or BBU, and convert those into radio signals and then transmit them to your mobile phone. Now, when your phone sends a signal back, the RRH captures it, filters it, and sends it back to the BBU in order to be processed. So basically, the RRH is doing both sending and receiving work of the signals. Technically, it includes both a transmitter as well as a receiver, and that is what makes it very similar to a transceiver. Now, this is the custom department's key point. Their logic is fairly simple. If the device can both transmit as well as receive signals, it sort of qualifies as a full communication unit. And a full communication unit should be taxed at a higher rate. They even found internal letters from Samsung which were written back in 2020 when the company itself described the RRH as a transceiver. This, according to the customs department, is proof that Samsung knew what the device was, but still they chose to classify it in a way that avoided taxes. But Samsung's argument here is a little bit more technical. They say that just because the RRH can send as well as receive signals, it does not really mean that it works on its own. It is still dependent on the BBU, and without the BBU, the RRH is absolutely useless because it that cannot connect to any network or even process data. So therefore, it is more like a fancy component, not a complete device in itself. And since it does not work independently, it should not be taxed like a standalone machine. And that is exactly where the entire confusion comes in. Should the RRH be seen as a part of a bigger system or as a standalone product in itself? Of course, it's not an easy question to answer, but still the answer could cost hundreds of millions of dollars. But that said, there is another small twist to the story which involves Reliance Jio. See, before Samsung started supplying RRH to Jio, the telecom company was importing very similar equipment itself. And guess what? Jio was also classifying those units in the exact same way, which is as parts and not as full devices. And at that time, the customs department did not raise any objections. According to Samsung, this had become a kind of industry-wide practice. And the thing is, once a practice becomes widely accepted, companies usually start relying on it by nature. And if the government suddenly changes its mind, it puts businesses in a very difficult spot. Now, of course, it is true that in 2017, customs authorities did reportedly tell Reliance Jio that this classification may not be valid anymore, but Samsung says that they were never told about this themselves. Basically, according to Samsung, no one from Jio or the customs department passed that message on to them. So when Samsung continued classifying these RRHs in the same way, they believed that they were doing the right thing based on what was common practice. And that is the crux of Samsung's defense here. They say, how can we be accused of misclassifying something if we were simply following what everyone else in the industry was doing and what the authorities seemed to be okay with in the past? But that aside, this particular episode also stands out for one more very interesting reason. See, it's very rare for Indian authorities to target individual executives of a multinational companies so directly. But in this case, 7 Samsung India employees have been named and also fined. And that sends a very, very powerful message, which is that the government is no longer just going after companies, but is also holding individual people responsible for whatever the companies are doing. And this could also change how global businesses operate in India. It might make executives a lot more cautious, especially when it comes to how their teams handle paperwork and compliance. Now, interestingly, Samsung is not the only global giant that is caught in this sort of a situation. To give you an example, Volkswagen is also dealing with a massive $1.4 billion tax demand over how it classified car kits. The government says that Volkswagen was basically importing fully built cars in the name of kits and they were dodging higher taxes. Another example is Kia Motors, which faced a very similar case with the customs department where they were claiming that it avoided 155 million US dollars in duty. Even liquor company Pernod Ricard has had to deal with a 244 million tax demand. And the list sort of goes on. There is Cairn Energy, Vodafone, BYD and many other companies which have had to run into these kind of disputes in India. And there is also a bit of a pattern here. In almost all of these cases, the issue sort of boils down to how the company described something on paper. And the real problem here is that the rules around these classifications can be vague or open to interpretation in many ways. So there is always the risk that what was seen very acceptable yesterday might be seen as a big violation tomorrow. And that brings me to the bigger picture of what's exactly happening, which is what does it mean for India's business environment? See, first, it raises concerns about how welcoming we are to foreign companies. The thing is, if big players like Samsung, Volkswagen and Pernod Ricard are facing massive penalties over what they thought were routine practices, it creates a feeling of uncertainty overall. It's not that the government should not enforce tax laws, don't get me wrong, they absolutely should. But if the rules feel unpredictable or if past practices suddenly become grounds for penalties, it can very well scare investors. It also makes India look like a tough place to do business in general. Second, this kind of dispute shows that different arms of the government may not always be working in sync. On one hand, India is trying to attract global manufacturers with schemes like Digital India, Make in India, etc., where we are trying to bring companies here to build things locally. But on the other hand, customs authorities are raising barriers by taxing imported parts very heavily. So in many ways, it currently feels like different parts of the governments are pulling in different directions and it's obviously confusing companies. And third, this shows how much confusion high tariffs can actually create. See, the more complicated your import duties are, the more time businesses have to spend trying to work around them. And it also means more time in what authorities spend trying to chase down possible violations. The real cost is not only money, but also wasted time, unclear rules, and the legal battles that may follow. That said, currently speaking, the Samsung case is with the tribunal. It definitely might get resolved there, or it might go through a longer legal process that drags on for multiple years. But either way, this case will sort of set the tone for how India deals with such disputes in the future. And that brings me to the end of the 2 stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, India's consumer goods sector posted an 11% value growth in the March quarter, with rural markets outperforming urban regions for the fifth straight quarter, according to Nielsen IQ. Rural areas contributing over a third of total sales recorded volume growth of 8.4%, down slightly from 9.2% in the previous quarter, while urban volume growth slowed to 2.6% from 4.2%. Second, Godrej Consumer Products Limited has announced a 700 crore rupee capex over the next 2 years to expand its new factories in South and North India and set up a new facility in Indonesia. The company reported a 411 crore rupee profit in quarter 4 with a 6.26% rise in revenue, though its consolidated EBITDA margin was hit by more than 50% surge in palm oil prices, prompting a 15 to 16% calibrated price hike. Third and the final one for the day, Tire Major MRF reported a 29% rise in consolidated net profit for quarter 4 of FY 2025 at 512 crore rupees. Consolidated revenue for the quarter grew 11% to 7,074 crore rupees, up from 6,349 crore rupees. That's all the news and stories I have for you today. I hope you enjoyed the show. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.